This video is for educational purposes only and is not professional financial advice. Do your own research before investing. Robinhood, ticker Hood, the company that handed a brokerage account to an entire generation that didn't think investing was for them, and then turned that into a $100 billion market cap. The question isn't whether this brand has resonance. It clearly does. The question is whether the actual business, the revenue, the margins, the competitive position, justifies the price the market is charging you to own it today. Over the next few minutes, we're going to work through all of it: the size of the opportunity, what the growth numbers are really saying, how Robinhood stacks up against its competitors, whether the unit economics hold up at scale, and whether the valuation makes any sense. Some of what we find is genuinely impressive. Some of it is going to make you lean back and ask a hard question. Let's find out which side wins. Robinhood isn't just a stock trading app, it's a financial services platform covering equities, ETFs, options, crypto, gold, and cash management, all wrapped in an educational layer that includes news, guides, and access to premium journalism. That's a broad surface area, and it maps to a genuinely large market. Two independent research firms put numbers on that opportunity. Grand View Research estimates the capital markets sector reaches $19.87 billion by 2033. Mordor Intelligence puts it at $18.18 billion by 2031. The range is tight enough that these aren't wildly optimistic projections. They're converging on the same story. Here's the thing worth sitting with, though. A nearly $20 billion addressable market sounds substantial, but Robinhood is already generating revenue at a pace well into the billions annually. That means the ceiling exists, and the real question isn't whether the market is big enough. It's whether Robinhood can continue taking share from entrenched incumbents and expand its wallet per user faster than that ceiling closes in. That question drives everything we're about to look at. Let's be straight with each other right out of the gate. The growth is decelerating. That's the headline, and you deserve to hear it first, not buried at the end. Look at the arc. Coming out of the pandemic trading boom, Robinhood's revenue peaked at $565 million in Q2 2021, then fell hard. By Q1 2022, it was down to $299 million, and year-over-year growth rates were deeply negative. The recovery was real but gradual: 47.5% growth in Q1 2023, 52.8% in Q2 2023, then stepping down, 29%, 24%, 40%, 40% again through 2024. Then came Q4 2024, $1.01 billion in revenue, 115.3% year-over-year growth. That number was electric. But here's where the deceleration signal gets real. Q1 2025 came in at $927 million, 50% growth. Q2 2025, $989 million, 45%. Q3 2025 hit $1.27 billion at 100% growth, another massive print. But Q4 2025 pulled back to $1.28 billion at 26.5%, and Q1 2026 landed at $1.07 billion, just 15.1% growth. So which is it? Tough comparisons from blowout quarters, or a business that's run into a natural ceiling? That's the tension this entire video is built around. Before making any claim about Robinhood's competitive position, let's look at what the peer data actually says, because the numbers tell a more nuanced story than the brand narrative alone. On revenue growth, Robinhood is compounding at 15.1% year-over-year. SoFi is growing at 28.8%. Virtue Financial at 26.2%. Interactive Brokers at 9.8%. Coinbase at 9.4%. Schwab at 6.4%. So Robinhood sits in the middle of the pack on growth, faster than the incumbents, slower than SoFi and Virtue. Now pair that with gross margin, and the picture sharpens considerably. Robinhood's gross margin is 83.3%. Schwab sits at 86.4% and Interactive Brokers at 89.8%, but both are growing at roughly 6 to 10%. SoFi is growing faster but at 75.1% gross margin. Coinbase at 74.6%. Virtue, growing aggressively, carries only a 48% margin. And the left panel shows that margin durability isn't accidental. Robinhood's gross margin is expanding, moving from 56.7% in 2022 to 83.3% today. That's not a company leaking pricing power. That's a platform business that's found its unit economics and is reinforcing them. The moat here isn't a single product. It's a high-margin, vertically integrated platform that incumbents can't easily replicate and fintechs can't easily match on efficiency. The gross margin story we just tracked in the peer comparison, that expansion from 56.7% in 2022 all the way to 83.3% in 2025, is only meaningful if the broader business is healthy underneath it. So let's stress test that. The Rule of 40 score is 87. For context, a score above 40 is considered healthy for a growth company. 87 isn't just passing, it's exceptional. You add the revenue growth rate to the profit margin and the result tells you whether a company is balancing expansion with efficiency. At 87, Robinhood is doing both simultaneously and doing it convincingly. The company is also free cash flow positive. There's no cash burn story here, no dilution treadmill to worry about. Now look at operational leverage. With 2,900 employees and trailing revenue well into the billions, the revenue per employee figure is striking. That's a lean organization generating an enormous amount of revenue per person. And when a company grows revenue faster than it grows headcount, that gap is real operating leverage compounding in shareholders' favor. Which brings up a fair question. If the unit economics are this strong, why is the growth rate decelerating? And what does that mean for the price the market is charging? Because right now, the price-to-sales ratio sits at 22.5 times against a sector average of 6.3 times. The market is paying a steep premium. Whether that premium is earned is exactly what we're about to find out. The PS ratio history panel on screen tells the story of a re-rating in progress. At the end of 2021, Robinhood traded at 8.5 times sales. By 2022, the market had lost patience, 5.3 times. 2023 saw a modest recovery to 6.1 times. Then the machine turned back on, 11.1 times by the end of 2024 and 22.5 times today. The sector median sits at 6.3 times, shown as the dashed line on that chart, and Hood is trading at nearly 3.5 times that level. This stock has been aggressively re-rated upward. The valuation meter on the right quantifies whether that re-rating is justified. The PS to growth ratio is 1.49 times. Here's what that means in plain English. You're paying $1.49 of valuation multiple for every percentage point of annual revenue growth. A ratio below 1 times would mean the market is pricing growth cheaply. At 1.49 times, the needle points to a modest premium. Not bubble territory, but not a bargain either. The analyst grades panel tells a similar story. 19 buy ratings, 5 hold, 2 sell. Consensus lands at buy from the sell side. That's a meaningful signal of institutional conviction. And the price targets panel grounds it in numbers. The average analyst target is $112.33, essentially exactly where the stock trades today at $112.73. The low target is $82, the high is $135. At current prices, the average Wall Street analyst sees the stock as fairly valued. The upside to the mean is essentially flat. The bull case lives in that $135 target. The bear case is a meaningful 27% drawdown to $82. 4 risks and 4 catalysts, and every one of them is grounded in what the data actually showed us. First risk, growth deceleration becoming structural. We watched year-over-year growth fall from 115% to 15% in the span of a few quarters. If that's a trend and not a comp issue, multiple compression follows fast. The market is paying 22.5 times sales for a growth story, and if the growth disappears, so does the premium. Second risk, multiple compression from macro or sentiment shifts. High PS stocks are rate sensitive. A shift in investor appetite away from growth names could compress this multiple toward the sector median of 6.3 times, independent of anything Robinhood does operationally. Third risk, competitive disruption. SoFi is growing faster. Traditional brokerages are copying zero-commission models. AI-powered financial tools are proliferating. Robinhood's head start is real, but it's not a moat with a drawbridge. It requires constant product velocity to defend. Fourth risk, stock-based compensation dilution, which has historically been material for companies at this stage and scale, and can quietly erode per-share value even as headline revenue grows. Now, the catalysts. International expansion represents a largely untapped growth surface for a platform this mature domestically. A continued push into banking, credit, and wealth management could dramatically expand revenue per user. Crypto market cycles have already proven they can deliver explosive revenue prints, as Q3 2025 demonstrated, and any sustained decline in interest rates historically drives retail investor activity, exactly the engagement Robinhood monetizes. Here's where everything lands. Robinhood is a genuinely impressive business. 83.3% gross margins, a Rule of 40 score of 87, free cash flow positive, and a platform that has structurally reformed how a generation thinks about investing. That's real. But the growth is decelerating, from 115% down to 15% in recent quarters, and the market is paying 22.5 times sales for a company where the average analyst target is $1 below where it trades right now. The bull case is that crypto cycles, international expansion, and product depth reignite growth and justify a sustained premium. The bear case is that 15% growth at 22 times sales is a setup for a painful re-rating toward the sector median. The verdict: watch. Not because the business is broken, it isn't, but because the valuation leaves almost no margin of safety at current prices, and the deceleration signal demands an answer before the premium is earned. Put it on your list. Let the next 1 or 2 quarters tell you whether the growth re-accelerates. If it does, you'll still have time to act. If it doesn't, you'll be glad you waited.